Hi, welcome back to the Crypto Experts. To be honest, aside from all the Pepe talk, nothing too special is happening in the digital currency world. But that shouldn't stop you from making money investing in currencies. So maybe it's time for you to explore stocks. See, it's common to see crypto lovers avoiding other markets because they love the blockchain stuff so much. Others would argue that the profit ceiling in buying and selling cryptos is much higher than if they dwell in stocks. However, investing in stocks also has many advantages that newbie investors don't know about. Continue watching to learn the difference in investing in crypto and stocks. When you're trying to figure out what sets crypto apart from stocks, the main thing you gotta keep in mind is that when you buy a stock, you're actually getting a slice of a real physical business. Even if stocks or entire industries lose their cool factor with investors, your stock still equals a piece of a legit operating company and its price matches up with the company's worth. On the flip side, cryptos are all online, no physical presence. This has a big impact on their worth, their usefulness in the real world, and how they're bought and sold. Okay, so if you're looking to buy stocks, you typically need a brokerage account to handle the deal. They'll ask you for stuff like your address, social security number, your John Hancock, and so on. That's actually kinda good, because it can help protect you if someone's trying to play you, like if there's some identity theft or fraud going on. But when it comes to crypto, it's a bit more of a Wild West. You store your digital loot in what's called a crypto wallet. This can be totally online, or it could be on something physical like a USB stick. Now this does mean you're more incognito, but it also means there's less safety nets. You've got some unique risk with crypto, like getting your stuff stolen by hackers, forgetting your super secret password, and not being able to get into your account, or just plain losing your USB stick and saying bye-bye to all your digital cash. Alright, so let's chat about this thing called market volatility. It can be seen as a good or bad thing, depending on how you look at it. Low volatility means things are pretty chill and your investment are more steady. But the downside is that you might have to wait longer to see some nice profits. This is usually what happens with the stock market. There's a lot of trading going on, which keeps things stable and makes it harder for the big shots to move the market too much. But because it's tied up with the governments and big companies all over the world, stuff like politics can shake things up. Now on the other hand, the crypto market is more like a roller coaster. It's a new market and it has some big highs and lows, which makes it sensitive to the moves of the big-time traders, or whales. These are the guys who own a bunch of Bitcoin, and their moves can really impact the market. But the cool thing about cryptos is that they're not as tangled up with governments and international institutions, which means they're kinda shielded from political drama. But here's the thing, while companies go belly up, they're usually not gonna lose all their value overnight like some cryptos can. So yeah, there's a bit of trade-off there. So if we're talking about smaller markets, they can definitely mess with how easily you can buy or sell your investments. Whether you're dealing with stocks or crypto, this whole buy-sell flexibility is what we call liquidity. For most, stocks are pretty much as liquid as it gets, because there are loads of peeps actively trading on the stock market. But for crypto, it's a bit of a mixed bag. How easily you can buy or sell depends on the type of crypto you've got. Like Bitcoin is generally smoother to trade because more people are into it. So if you're looking to buy or sell Bitcoin, you're likely to find someone ready to make a deal. But just a heads up, both stock and crypto traders can get burned by something called slippage. That's when you lose money because you had to dump a big chunk of your investment when not many people were buying. But this kind of stuff can hit crypto folks harder, mainly because there are typically fewer people trading crypto compared to stocks. So there's a pretty big difference between the stock and crypto worlds. The stock market has a ton of rules to try and keep things fair for traders and investors. It's like a heavily policed playground, and this comes with its own costs. You've got to pay the broker, the bank wants their piece of handling payments, and don't forget about taxes on your profits. It can get pricey. On the other hand, trading in the crypto market doesn't burn as big a hole in your pocket. The costs related to making transactions on the blockchain are just teeny tiny mining fees. And the exchanges themselves don't have as many expenses as stockbrokers when it comes to buying and selling. Right now, crypto markets are pretty much the Wild West with little regulation, but a lot of folks are saying we need more rules to keep things in check. So we'll just have to wait and see how the rules for the crypto market shape up over time. Okay, so let's dive into this regulation stuff a bit. In the US, there's this big shot agency called the Securities and Exchange Commission, or SEC, that keeps an eye on stocks and the stock market. They make sure everything's on the up and up with the companies that are publicly traded. Meanwhile, cryptos are kinda like the wild child of the financial world. They're mostly unregulated. Some like this because they're not big fans of government control. Each cryptocurrency runs on its own decentralized network with a bunch of people working to keep the tech in tip-top shape and the whole operation legit. However, the lack of regulation for crypto is still a big question mark. Cryptos and their exchanges could see some serious changes or even disappear if the rules change. Like there was a big debate in 2022 about whether crypto is a security like stocks or a commodity. It's kinda like being in a thriller movie. We're all on the edge of our seats waiting to see what happens next. So lots of investors try to create a mix of investments that don't all behave the same way when the market changes. Typically, stocks tend to dance to the beat of the overall economy. Things like inflation, joblessness rates, and interest rates can all make them move. Now, some people who are really into crypto think it doesn't play by these rules. They say it's a non-correlated asset, which is just a fancy way of saying it doesn't react to market events like stocks and bonds do. They also think it could be a financial superhero that protects against inflation. That's a big deal if you got a lot of investments that usually get hammered by inflation. So in their view, adding some crypto to your investment mix could help balance things out. Alright, here's the lowdown. Stocks and cryptos are like apples and oranges. When you own stocks, it's like having a tiny piece of a real-life company. On the flip side, crypto is all digital and doesn't have the kind of inherent value that stocks do. Plus, it's not kept in check by bigwig authorities like the SEC, which helps protect stock investors. But that doesn't mean cryptos are out of the game. They bring some fresh and exciting opportunities to the table that you might not get with old-school stocks. It's a good idea to spice up your investment mix with a bit of both. Stocks can offer you some solid ground for the long haul, but crypto can let you dip your toes in the rapidly growing digital economies like this thing called Web 3.0. Well, that's it for today's video. This was the Crypto Experts on the difference between investing in stocks and cryptocurrencies. Which do you like better? Comment below. Until the next video, bye!